If you invest in commercial real estate, the difference between a regular loan and a CMBS loan could cost you millions in personal liability. And with the way the real estate market has turned lately, nobody wants to guarantee a loan they don't absolutely have to. In this video, I'm going to explain exactly what CMBS loans are, how they work, and why they might be a perfect financing solution for your next commercial property. After watching this, you'll understand whether a CMBS loan is right for your situation and how to qualify for one. My name is Bashoy Khabib, and I'm the realest real estate attorney you know. Over the past 12 years, I've closed over 1,000 transactions totaling $12 billion. I've helped dozens of clients navigate the complex world of commercial financing, and today, I'm breaking down one of the most misunderstood but potentially valuable loan options out there. So what exactly is a CMBS loan? CMBS stands for Commercial Mortgage-Backed Securities, and it's a loan secured by commercial real estate that gets bundled with other similar loans and sold to investors. Instead of your loan staying with the original bank, it gets bundled together and other similar loans are sold to investors who want to make money off the interest payments. CMBS loans typically have more relaxed credit requirements, but they're only available for income-generating properties. The most important thing you need to know about CMBS loans, they're non-recourse, which is just a fancy way of saying you don't have to sign a personal guarantee. That means if everything goes wrong and you can't pay back the loan, the lender can only take the property itself. They cannot come after your personal assets. This is huge for investors trying to protect their wealth, especially in this declining real estate market. Let me give you an example of why this matters. Someone I know bought an office building using a traditional bank loan. After COVID, he lost most of his tenants and defaulted on his loan. Not only did he lose the property, but the bank came after his personal assets and made him liquidate another one of his real estate holdings to pay the shortfall. If he had used the CMBS loan, he would have only lost the office building. And now you understand why this is so important. Now let's talk about the key features of a CMBS loan. First, they typically come with 5, 7, or 10-year terms, but they're amortized over 25 or 30 years. So what does that mean? It means your monthly payments are calculated as if you're paying the loan over 30 years, but the entire remaining balance comes due at the end of your term, also known as your balloon payment. Most people refinance when that balloon payment comes due. CMBS loans start at a $2 million minimum and go up from there. The interest rates are fixed, usually based on something called swap rate plus a spread, which is basically the lender's profit. Another big benefit of CMBS loans is that they are fully assumable. That means if you decide to sell your property, the buyer can take over your existing loan. This can be a huge selling point, especially in a high interest rate environment like we've been in. Imagine trying to sell your building when you locked in a 3.5% interest rate and current rates are double that at 7%. Buyers will pay a premium for that assumable loan. Now, what does it take to qualify for a CMBS loan? This is where things get interesting because the qualification process is actually more forgiving than traditional commercial loans. CMBS lenders focus on two main things. First, the debt service coverage ratio, or DSCR. This looks at whether the property generates enough income to cover the loan payments. Most CMBS lenders want to see a DSCR of at least 1.25, meaning the property generates at least 125% of the loan payment. So if your monthly loan payment's $10,000, you need to generate at least $12,500. Second, they look at the loan to value ratio, or LTV. CMBS loans typically max out at 75% LTV, meaning you'll need to put down at least 25% of the purchase price. That's pretty standard for commercial real estate. That's not crazy. Unlike traditional banks, CMBS lenders care more about the property's performance than your personal financial situation. Now, don't get me wrong. They still want to see that you have some liquidity and net worth, but the requirements are much less strict. Generally, you'll need post-closing liquidity of about 5% of the loan amount and a net worth of around 25% of the loan. Here's what happens behind the scenes when you get a CMBS loan. After closing, your loan gets pooled with other commercial mortgages and placed into what we call an REMIC trust. That stands for Real Estate Mortgage Investment Conduit Trust. This pool of loans is then sold to investors as securities. This process is called securitization, which you may have heard of. It can be confusing. It's a pretty simple concept. Once that happens, you don't deal directly with the original lender anymore. They're out of the picture because they've sold the loan. Instead, you'll work with a loan servicer who collects your payments. If you ever run into trouble making payments, a special servicer gets assigned and takes over to either modify your loan or, worst case scenario, handle the foreclosure. Now, there is one significant downside to CMBS loans. They're not easy to pay off early. They come with pretty hefty prepayment penalties, either through yield maintenance, which is a percentage fee, or defeasance, which is replacing your real estate bond with bonds as collateral. Most CMBS loans don't allow you to prepay in the first 2 years at all. Now, these restrictions exist because the investors who bought the securities are expecting a certain return over a specific time frame, and if you paid them back right away, they're not hitting those returns. So just be aware of that. So, should you consider a CMBS loan? Well, you're a good candidate if you're buying a stable commercial property like a retail center, warehouse, or apartment complex. You want a fixed interest rate with no personal recourse or no personal guarantee. You plan to hold the property for at least 5 to 10 years. You're looking for a loan of $2 million or more. You like flexible underwriting standards better than traditional banks offer. And on the flip side of that, CMBS loans are probably not right for you if you're planning major renovations or significant changes to the property, you think you might sell or refinance in the next few years, or you need a ton of flexibility with your loan terms. If you're considering commercial real estate, don't make a financing decision based solely on the interest rate. Think about your overall risk profile and how much of your personal wealth you're willing to put on the line. If you like this video and want to learn more about commercial real estate financing, feel free to reach out to me directly. Also, hit the like button and let me know in the comments what topics you want to learn about next. Thanks for watching. Don't forget to subscribe for more videos every week, and I'll see you next time.